Welcome, everybody. Welcome. I am just opening up and people coming in through the waiting room. Just while we wait for people to join us, just from a quick housekeeping perspective, as this is a webinar, your cameras and mics are automatically off and they have to stay off. So the best thing, if you have any questions, hold them till the end, firstly, because they may get answered as we go through. And if not, I think if you take note of the phone number and the email address at the end, then come back to us with bespoke questions, because I can't see the Q&A or the chat box as I go through this presentation, unfortunately. So it is being recorded, so you don't need to worry about taking copious notes. And the benefit is that you'll then have that recording to either rewatch bits or pass on to family, friends, anybody else in a similar situation. So hopefully you're on the right event. It's a session around care funding and how it all works, trying to make it a little clearer for you. And what we're going to cover by way of the agenda, I've kind of deliberately picked that road sign, actually. Obviously, the audience today, I don't know what stage of the journey you are. So I'm assuming some of you might be at the very beginning, not encountered this before. Some of you may have sort of gone through this journey, the confusion, and you're just now really sort of looking for longer term advice and solutions around care funding and what your options are. So I'm covering kind of all bases here because I don't know who's at what stage, but I certainly know that most people, when they start dealing with care funding, do find it very, very confusing, bewildering, and there's lots of misinformation around. So the purpose of this session is to clarify and answer what looks like a really, really simple question, but it has quite a complex answer. So who does actually pay for a stay in a care home? Obviously, people can have care in their own homes as well. This session is focusing really on when a move into a residential setting has happened. We're going to touch on what's happened to the lifetime cap on care costs. If you remember politicians in the past telling us that we're going to have a cap on catastrophic care costs, where are we at with that? What has to happen, or what are the options around the family home? Some people think it has to be sold. We'll just dig into that a little deeper and see if that's true. And in closing, we'll just really look at what solutions there may be to ring fence legacies. Most people in this situation do want to make sure some of their wealth and hard-earned capital passes on to another generation, and that the money doesn't run out, leaving them vulnerable to what might then happen. So we'll look at what options there are. Our website address is there displayed throughout this, so do reference that if you want to, eldercaregroup.co.uk, because it does have quite a lot of additional information on, but I will, as I say, give you our phone number and email address at the end. Just before I start tackling that agenda, which hopefully looks the questions that you wanted answers to, before I start working through that, just by way of a bit more of a formal introduction to ourselves here at Eldercare, we are a firm of independent financial advisors, IFAs, but we've all been accredited by the Society of Later Life Advisors, and that's really the sort of minimum gold standard kite mark to look for anyone taking advice here, because IFAs, as a rule, don't really understand care funding. It's its own little niche topic. So as a bare minimum, you want to be talking about funding with a SOLLA Accredited IFA. Here at Eldercare, we only advise on care funding. We don't get involved in other later life matters. Some of our other SOLLA advisors have a bit more of a broad spectrum, holistic advice around retirement and that type of thing. We deal only in care fees funding, the point of need. And it's my business. It was actually set up in its current format in around 2007, simply because we went through this as a family. We went on this journey with my grandparents and we got absolutely no advice. And I'm not pointing the finger or blaming anyone for that. It was 100% a case of you don't know what you don't know. So if you don't know that there are solutions or options out there, you don't seek the advice. You don't ask anyone if they can, oh, could you put me in touch with somebody who can tell me how to preserve some of the capital? Or could you tell me somebody who can talk to me, about a product that will give us peace of mind? We just didn't know these things existed, so we didn't source the help. I found out everything I know now far too late. So the purpose of setting up the company was simply to share this information with people going through the same journey as we did, and make sure you're much, much better informed. So whilst we're here at Porthaven's quite kind invitation, we don't have a link with them, with any care provider in the UK, but we do work with many of them. And that's because we are so niche. There isn't another firm in the UK that only advises on how best to pay for a care home. So that makes us in quite high demand. So you may find us through various other sources. We are having money conversations with families, so it's absolutely appropriate that you check and find that we are listed on the Financial Conduct Authority register. That's where you must check for anyone you're taking financial advice from. Make sure that they're clearly and easily found on there. And location, as we know these days, is simply not a problem. We can deal through Zoom, through Teams, through old-fashioned telephone, email. But actually, pre-COVID, that's how we delivered our advice anyway, because we wanted to make sure that A, we kept costs down, and B, that nothing got lost in translation. So if I spoke to a family member on the phone and followed it up with an email summarising our conversation, that could be passed on to the rest of the family and nothing gets missed. As I say, it keeps our cost base down. We're not having to charge for appointment time, travel time, etc. So that means we can offer literally a free consultation over the telephone to see if we can even help. We can offer to research financial solutions for you at our expense, not yours. And it's much later down the line that you would pay us a fee if you were going to be taking advice around a financial product. But certainly just to have a chat, see if we're the right fit for you, how we can help, that's all done at no expense to you. So back to that agenda and looking at that simple question, who pays for care? How do I answer that in 5 minutes? Well, maybe it will take me 7 or 8, but I am simplifying it here, of course. So there are 3 funding streams when somebody moves into a residential care setting. They might be paid for by the local authority, social services, the council. That's actually all the same place. I mean, why have 3 different names? There we go. Somebody could be paid for by our much-loved National Health Service, or they are classed as a self-funder. Private fee payer is another terminology that's used. There can be some crossover between these 3, but I'm trying, as I say, to keep it simple. So if we take the first one, I think people are familiar perhaps with the funding being linked maybe to how much money you have. But actually, there's a step before that whereby it's about what your care needs are. So everybody is entitled to have a care needs assessment, and they can contact their local authority. Carers can have a care needs assessment in case they, qualify for some respite care. It doesn't mean to say, however, that everybody will meet their local authority's eligibility criteria. So you have your needs assessed, and the local authority will say, yes, you do need to go into a care setting, or actually, no, we think you could still have your care needs met at home with a little bit of support. So it's a conversation about how best to meet somebody's care needs that should happen first. And it's only after that that the financial conversation should take place. We call it a financial assessment. A means test is something you'll perhaps be more familiar with, but it should be in that order. It shouldn't be that the local authority asks how much money somebody has before they look to assess their care needs. Okay, and it's often done the other way around. So it's not, as I say, a given that somebody will meet the eligibility criteria. My auntie, for example, fairly recently widowed, felt she would be better looked after in a care setting from a social perspective and a security perspective, but there was no way the local authority would agree she met their care criteria. So regardless of her financial position, they wouldn't help. So it's important that eligibility criteria we're going to look at for the gateway to a couple of other things later. So it's definitely not a foregone conclusion. I think around 20% of people don't meet the eligibility criteria when they're assessed. But it's care assessment first, then financial assessment. And what's the financial assessment looking for? I'm sure you'll know this figure. It's looking to see whether you have above or below 23,250 of capital. That's in England and Northern Ireland. It hasn't changed for about a decade. So with the recent inflation rates, that's really ratcheting back in value. Scotland is about £7,000 more generous. It's actually at its most generous in Wales, where it's £50,000. And these are per person, so we can double for a couple. So they're looking to see, do you have above that figure or below that figure? What are they counting as capital? Well, I could be fairly flippant and say pretty much everything, but there are three notable exceptions, I think, worth mentioning. The first is if you are in a couple scenario, then it is only the person going into care whose assets are assessed. So if we have jointly owned savings, for example, they can only include 50% of that. But of course, that's going to be 50% of an ever diminishing sum. So it really makes sense if you are in a couple with jointly owned assets, you separate them out. You don't mess with the percentages, but the person staying at home put their 50% into their own name. So it isn't ever included in the calculations. And then we just run the money down for the person in care. Obviously, the spouse staying at home, anything owned in their own name, 100%, is not assessed. So you are very, people have lived as a couple maybe for years and years and years. When it comes to care, you are very much looked at as an individual. So that's important to note. The family home, again, we hear of so many people, even people selling up, downsizing to release money for their husband or wife to pay for their care, when if they had stayed in that property, that equity is protected because the property is completely disregarded forever while a spouse or relative over the age of 60 lives there. And there are a couple of other exceptions as well. So unless you wanted to move because the property was genuinely too big and you wanted to relocate for some reason, but if you're doing it to release cash to pay for care, you don't have to do that because the property is protected while the spouse lives there. Now, if the spouse later on moves into care themselves, then from that date, the value will form part of both their means tests, or the spouse at home predeceases the one in care. From that date, it's assessed, but otherwise it is not, and it's not retrospective. They don't come back later to claim on it. It's completely invisible by virtue of the spouse living there or relative over 60 living there, but not a relative over 60 who happens to move in the week before mum or dad moves into care. That would be not appropriate as far as the local authority were concerned. The third exception, less common, but common enough for a mention, I think, is that if people hold an investment bond that includes life insurance, now this would typically be a product that an IFA would have set up for somebody. You wouldn't tend to go and buy these direct from the insurance company. So they use terminology on the document such as unit values going up as well as down, and certainly has wording that says life assured. One of those bonds, no matter how much money is in it, those are disregarded assets as well. Now, you can choose to cash them in and use them to pay for care, but the start point is that the local authority can't assess the value. So actually, again, if you're watching and you're in your 50s, 60s, 70s and you come into a lump sum of money and somebody advises you that, an investment bond with life assurance could give you good returns, better than the bank or building society, there is a side note advantage that also the local authority can't include it when assessing somebody's means. So if you're not sure, if you've got paperwork for somebody, you're acting as power of attorney and you're not sure if this investment is or isn't one of these, it's something we can easily check. Otherwise, pretty much everything. So we're talking about a second property, holiday lets, any rentals, business assets, cash under the bed, national savings, ISAs, stocks and shares, premium bonds, all of these are included in the means test. And it's not just about capital. Some people think, oh, you know, the house is going to be disregarded because one parent's staying there and this parent doesn't really have much cash. That might be the entry point for the means test. It goes a stage further and it does take into account a person's income as well. So if that person, we are talking again about a married couple scenario, if there is a private pension, the spouse not needing care can retain half of that private pension. It's got to physically be paid to them, but they can certainly keep that. But the state pension, the other 50%, any other income, all of that gets assessed. And what's the impact of that? Well, local authorities have a limit on what they'll pay. It has to be a genuine figure. It can't just be a made-up figure. There needs to be a care home in the area that will meet that person's needs, that the local authority will pay for in full, accepting then that the individual has to contribute their income towards that. So let's just say for a minute, the local authority has a contract with a particular care home in the area. They agree to pay £700 a week, but the person we've just been talking about has a £700 a week pension. Perhaps they worked for civil service for 40 years or something. Then in reality, they won't get anything from the local authority because what they have as assessable income is equal to what the local authority would have paid anyway. That's rare, but it is certainly the case that if the local authority is going to pay 700, most people will have 200 or 300 of income. So the local authority ends up only paying 300 or 400. So it's a combined amount when we talk about what the local authority will pay for someone. And as I say, there must always be at least one care home place that meets that person's assessed care needs and that the local authority will pay for with the income being contributed, but that nobody else is troubled or asked to pay a top up, because of course not everybody has anyone available, a family member that could pay a top up for them. So that's really important to be aware of. And again, we hear people thinking ahead and saying, well, if mum ran out of money, we'd get 700 from the local authority, let's say, and she could add her pension to that so she can afford 1,000 a week. I'm just saying that's not how it works. Her pension will go towards what the local authority will pay. So when are top-ups requested then? Well, as I say, there must always be, if somebody is starting their journey being paid for by the local authority from outset, there must always be a no top-up option. There has to be a care home place that's offered. If the county doesn't have any, the local authority might have to just pay more. You know, they can't just wash their hands and expect top-ups to be paid. If, however, the care home place that they do offer and agree to pay for, family or the individual has a preference to go elsewhere, that elsewhere is more expensive, that's the point legally that a third party top up can be requested. Okay, so it's optional because of course that person doesn't have to move to the more expensive one if there's a no top up option available. You can certainly transfer what the local authority have agreed to pay somewhere else, and if that care home requires a higher fee, the third party top up can be requested. The other time that a third party top up can be requested is if somebody actually starts off paying their own way. They start off as a self-funder and then they subsequently run out of money, be that 6 months down the road, 6 years down the road, depending when that is it 6 months or is it 6 years? What does the care home contract say about this scenario of somebody running out of money? What was discussed at the point that the person moved in? It may be that a third party top up is required for the person to stay at that home. People think it's the local authority that move people out of homes. It's not. The local authority will have an amount that they're prepared to pay, and they might not be able to afford that home. It would then be down to the home as to whether they would accept that lower level of funding. Sometimes and often the care home and the local authority can come to some sort of agreement. But if you're not sure about this, these are the sorts of questions to ask when choosing a care home placement, that you understand what would happen in the scenario of the money running out. Although we are going to talk later on about how to hopefully prevent that happening in most instances. So that's really the whistle-stop tour of our means-tested funding, our local authority funding system that's been around for a very, very long time. There was talk of the 23,250 threshold going up so that you got help sooner, but that all seems to have gone quiet. And you would have also possibly, it might not have been on your radar at the time, so it may have passed you by, but we've had about a decade of talk of a lifetime cap being introduced. The original legislation for this came in 2014, and it was going to be a £72,000 cap on care costs. That got U-turned, well, it got delayed, then U-turned in 2015. And then we had Momentum and Boris Johnson standing on the front steps of Downing Street saying, no, there will be a lifetime cap on care costs. And it was set at £86,000, bit of inflation. And I used to do this presentation spending about 10 minutes now on how the lifetime cap would work, how it wasn't really going to affect very many people because it was only ever going to take into account local authority contributions and credit those to somebody's cap rather than what they were actually paying as a self-funder, which is often much more. But I'm not going to need to go through the detail of any of that because it's been completely cancelled. And, you know, again, if you're following politics, you'll know that there's another commission, there's another review. I think the changes they're looking at the moment are much more structural to how the NHS works and how it will interact with social care rather than focusing on the money side of it. I think there is reluctant resignation that most people will have to pay for their own care, and there's no change to that on the horizon. We will keep people updated, of course, if changes do come in, so you can always sort of keep half an eye on the news section on our website on an annual basis, 6-monthly basis. But yeah, no cap. If you read anything online about the lifetime cap, it's out of date. It has been fully cancelled. So my second stream of funding that I mentioned, this would be an entire webinar topic in itself, and I'm not medically qualified, so I can only flag up to you for the purposes of today that this funding stream exists. And the best way I can explain it in simple terms is when you go to hospital, you don't get presented with an invoice on the way out, okay? So the sort of conditions that render a stay in hospital are normally quite complex, unpredictable, unstable. You can't leave until things are under control. And there's certainly a primary health need. You're not going in there to have help with your activities of daily living. You're not going in just to get some help with washing and dressing and food preparation and getting in and out of bed. You've got a health need. That's why you're in hospital. Well, if you have a health need, but you're in a care home, the principle is still the same, that the NHS might have to pay for you. So they might pay for you in full if your needs are complex and unpredictable. That you can access the sort of assessment tools that they use. You can see what things they're looking at. And it is possible that all of your care would be paid for by the NHS if you meet that criteria. More commonly, people qualify if they need just a bit of nursing care. They qualify for funded nursing care. Sometimes they don't even know they're getting this. It does go directly to the care home, and if you're in a nursing care bed, it kind of goes to the care home, gets knocked off the fee, and you're just invoiced for the balance. So you might not even be aware if it's being awarded. So I'm flagging this because it might not be something that applies now, but if somebody's health deteriorates and it is health now rather than social care, then be aware of this and have that discussion with the care home, and they can certainly guide you to how an assessment might get done. So be aware of it. It's not means tested, and tax-free, so worth being aware of, even if it's for the future. It's quite difficult to claim, but shouldn't be. So just do your research before you start that journey and make sure that administratively they're doing everything the right way. And then that leaves us with our third category, the self-funders, the private fee payers. I mean, by purpose of elimination, if you have too much money to get state support and you're not poorly enough to get the NHS support, that's what puts you in this category. And practically the only state benefit or support realistically that you can get as a self-funder in a care home is attendance allowance. Now, I mention it Two reasons. You've either never heard of it, in which case look up on the Gov website how to claim attendance allowance, or you think it stops, you knew about it, you were getting it, but you think it stops when you move into care. It doesn't. As a self-funder, it carries on. If you moved into care and later on became state funded, then it would stop. But it is certainly still for somebody paying for their own care, and it's either a low rate, just at the moment 72.65, or a higher rate. The difference between the two simply being whether you need somebody to attend to you during the night time as well as the daytime. And what they're looking for there is three attendants per night. So if somebody needed to come up and help with 3 bathroom visits, or 20 minutes roughly of time spent attending to you during the night, they seem to be the triggers there. So non-means tested, tax-free, doesn't have to be put on a tax return, doesn't affect any tax on pensions, etc. So could be nearly £6,000 a year, worth claiming, even though we appreciate it doesn't really touch the sides. But the only other state support for self-funders, and again, not going to be applicable to everybody, but it is applicable to many, is if you have a property and limited cash, so cash under the 23,250 threshold, you have a property, you don't have a spouse or relative living there, this is your perhaps a widowed individual. If that property is left vacant and you move into care permanently, then the first 12 weeks of your permanent stay in the care home, the local authority would have to ignore the value of the house, treat it as if it's not there. And by virtue of your other money being under the threshold, they would have to treat you as if you were a local authority funded individual for those 12 weeks. You do, if you remember right at the beginning, I said the care assessment is the gateway to a number of things. The care assessment is the gateway to this. So you don't get this automatically. You unfortunately have to have a local authority assessment. And we know at the moment in some areas the queue is very long. So you may decide not to bother with this when you actually work out what it's worth to you, but I still have an obligation to tell you. So you have your care needs assessment with the local authority. They agree that you need to be going into care. If they don't, you're not going to get this. And then they say what they would pay for you if you were going to one of their care home placements, and then they give you that at the home of your choice for 12 weeks, accepting that you've got to contribute your pension towards it. Now, you don't have to pay this money back. This is not a loan. This is free money. But as I say, it might only be 200 or 300 a week when you do the math. But it is important to note that you can have it paid to the care home of your choice because you're going to be self-funding longer term. So you don't have to go to a council bed, as it were, for 12 weeks and then move. You can have this money paid anywhere. But of course, the home that you've chosen may very well want a top-up. Do you remember I said earlier about top-ups? And I said they're paid by a third party. In this scenario, and only this scenario, you can be your own top-up. So if you've got 20,000 in the bank, you get the 12-week disregard, you can use your 20,000 to be your own top-up. What happens at the end of the 12 weeks? Well, that's now back to the question about having to sell the family home. You don't have to sell the family home necessarily. Now, some people might want to. They might want to release the capital. It gives them more options. They might be thinking, well, we'll have to sell it in a few years for probate, so let's get it done now. But others might think that, well, we could get a pretty good rental income on this, actually. It's near a school and it's in an area that's in high demand. And the returns, when we've done the maths, and you would have to be careful doing the maths because you've got to factor in income tax on the rent, wear and tear, periods where you might not have a tenant, and so on and so forth. But for some people, it might be an option. And yet you're thinking, yeah, but even with the rent and the attendance allowance and the pensions, still not enough to pay the fees, we're going to have to sell. I'm just going to say to you there is an option, and it is not equity release, because equity release companies won't lend on an empty property. And this is empty, right? Person's moved into care. So you can't get an equity release, but you can get an equity release if you do it from the government. They call it a deferred payment agreement, a deferred loan, and it follows, as I say, on from the 12-week disregard, so you get that first. All local authorities have to have a scheme in place, although they can turn individuals down. Why would they do that? They might do that if there's already a loan, a mortgage, a charge against the property, because they want first charge. They might turn it down if there were any structural issues, as you'd expect, and they might turn it down if there wasn't much equity in the property, if it was low value. They would want to see that you could absorb at least sort of 2.5 years worth of loan into the property equity. But otherwise, they do have to have a scheme available. They can charge interest and a set-up fee, but much lower than a mortgage or an equity release arrangement. Yeah, back to that gateway, you still have to meet their care criteria first. If they say you don't need to go into care, but you're choosing to, this won't be available to you. They have to agree that you need to move into care. Your other assets have to be under the threshold. So you might not use this straight away. You might rent the property out, use £50,000 of savings until the savings drop to 23 to 50, and then ask for the loan. So, you can ask for it at any time. Could be used for short term, just while you get it sold, or long term while you're renting out. And the benefit here is the local authority can lend you full fees and not restrict it to that £700 or £800 a week local authority rate. So it's really, really helpful in that scenario where people are worried about cash flow or don't want to sell the property until their loved one's not here. The loan does have to be paid back on that person's death. And it follows on from the 12-week disregard. It's a loan from week 13. Don't let them charge you a loan for the first 12 weeks. That is a freebie, okay? And again, we're not hearing that information coming out correctly from local authorities. So just be aware of it. Might not apply to you, but just be mindful that this thing exists. And then sort of if we open up the definition of self-funders to people not restricted to just a house and minimal cash, this could now be somebody who sold the house already, someone who's got a business asset, someone who's got investments that they've built up over the years. When we talk to families, and it is normally the son or daughter or niece or nephew acting as power of attorney, when they call us, when they're choosing a care home and looking around, they share with us two main concerns, and I think it might ring familiar with yourselves. What they're worried about is, without a crystal ball, so everyone says, look at what you can afford and do some forecasting, cash flow projections. How do you do any of that if you don't know how long someone will need the care? So you can work out what the weekly fee is. And remember, don't just multiply that by 52 and divide that into the savings. Remember that the weekly fee, you can deduct from that the person's pension and attendance allowance, because care fees are pretty much all-inclusive prices. You don't really need much spending money on top of that weekly fee. So what might look quite a daunting fee, knock the income off it and divide that into the savings. And you might find that you thought you had enough for 3 years, you've actually got enough for 4. So that's a concern, absolutely, but we can just sort of talk through and do some cash flow forecasting to see how long the money will last, and that might actually affect the choice of care home that you make. But the natural flow on from that is that if you don't know how long the money would last, and if somebody does live a long time, what happens if they outlive their capital? The piggy bank is empty. It is a genuine concern. Now, we aren't able to address that concern and provide a solution for everyone. There simply are certain scenarios, perhaps, where somebody has enough money to fund a chosen care home for a year or 2 years. We can't do anything in that scenario to prevent the money running out. All we can do is suggest an open dialogue with the care home. Would they be prepared to accept somebody in, knowing that they're going to run out of money in a year? Should they be talking to the local authority at this stage? And certainly they should know when to approach the local authority. But for anybody who is self-funding and doing the correct cash flow forecasting, taking into account income, for any of those people who've got upwards probably of 3 years worth of funding, there's a solution that might alleviate both those concerns. I say might because it is different for everybody, but what we know is that about 85% of self-funders for whom this could be a good solution will never ever get to hear about it. Now, the great news is, if you've got as far as this part in the webinar, you'll now know about it. You may even have known about it before, but you would be in the minority. It's a staggering statistic that the people who would benefit from knowing about this just don't in the main. And we as a family, when we were dealing with my grandparents, were absolutely in this category. And that's why I'm presenting to you today, so that you switch from 85% to 15%. So what am I talking about? Share it with me. It's not very exciting. It's not very glamorous. It's a financial product at the end of the day, but it is a way of capping costs yourself, because for most self-funders, they see only one option, which is to keep the fingers crossed and run the money down. They might invest it and it might last a little bit longer, but of course investments in the traditional sense go up as well as down. And are you going to take those sorts of risks with somebody else's money when you really don't know how long you're going to need it for? Our regulator says that investments in the traditional sense need to be left alone, untouched for 3 to 5 years to sort of ride out any peaks and troughs. So most people that we talk to don't have that luxury of time. They need to get hold of the majority of the capital now. So this alternative, just to give you two choices rather than one choice, is a type of insurance, a way of insuring care home fees. But of course, when I say insurance, most people think, well, that's something you have to do, ahead of time. You'd have to plan for that. You'd have to set one up long before you needed care. And unfortunately, you can't do it ahead of time. This is an anomaly, if you like. It's an insurance that you can only take out at the point of moving into a care home or having care in your own home. You can do it after you've moved in, but you can't do it before. Now, the Google search engine term is a care fees annuity. Okay, but that is a name that sometimes gets confused with pension annuities. So even if you did a Google search engine term, it's no doubt going to bring a search rather. It will bring up pension annuity calculators galore. So it's a very different product, but has similarities. So not the same as a retirement annuity, but the concept of swapping a one-off lump sum, giving it to an insurance company, and then getting an income in return for the rest of your life, that as an idea is where it comes from. However, a retirement annuity, of course, is for typically somebody in their 60s who might be living till they're 90. They might want index linked. They might want a spouse's widow's pension attached. So suddenly this really big fund that they've built up over their working life, when they retire, shrinks down to quite a low income. And so annuities as such get a bad reception if you mention them sometimes. People will say that they're expensive or that they're poor value. And as I say, in the context of a pension annuity, I wouldn't disagree. But our clients, the sorts of people who are looking and getting quotes for care fees annuities, they are not generally 60. Our average client age is 89. And our oldest client to date is 103. So, of course, those people are not expected to live as long as your typical pensioner retiring. So the amount of income that you get from your lump sum is much greater. So where you might have got maybe a 5% return on your pension annuity, you might get a 30% return or a 25% return on your care annuity, because, of course, it is also going to take into account your health. So every 89-year-old that we quote for, even if they need the same amount of income from it, will be given a different quote. The insurance companies that offer these products, and we're just an intermediary, we don't offer them ourselves. We're your kind of go compare, give us your information, and we go out to the market and get all the quotes for you. The insurers want potentially to contact the GP and have access to the medical notes. Not always, if the family can provide a lot of information. But what they will also want to do, and what they put a lot of weighting on, is they'll want to book a telephone call and talk to somebody at the care home that looks after the individual and get a feel from them as to what their day-to-day needs look like. What medication are they given? How much help do they need with the activities of daily living? And all of that gets bundled into the underwriting decision the insurance companies make. So the individual themselves won't even know that this is going on. This is very much in the background, contacting the doctor maybe, booking an appointment with the care home, getting information from the family. Our job is to talk to the individual or the attorney and work out how much income is actually needed. So what's the gap between care home fees and income? And then we go, as I say, to the market and find out what these insurers would all charge by way of a lump sum to provide that income for the rest of the person's life. Okay, so these are a gamble. I have to put it that way. They're not an investment. You don't put the money in and then see how it grows and take it back out. You put the money in and it's locked in. And you get the positive, you get an income for life, no matter how long that is. But the negative is if the person dies sooner than the insurance company had kind of predicted or priced the policy, then unless you've included extra protection, that money is at risk. I think two ways to pay for care both have a risk. I think if you go the investment route, that's not risky to start with because you've put the money in, you can get it back out, you can still touch it. But as time goes on, then it erodes, and it is that risk of it running out in the event of longevity. There aren't very many people who have a big enough pot of money that it could never run out. Okay, so some do, but most you can see a point in time when it would all deplete. The care fees annuity on the other side, opposite type of risk. It's very risky early on if somebody dies because you will make a loss, the estate will make a loss. But the flip side then is that in the event of longevity, there's no more capital erosion. The capital erosion has all happened up front. So it's a gamble around somebody's life expectancy, but so is the alternative of just paying as you go along. So what our job is, not only to go and get those quotes, but then to put quotes into an advice report that answers all the sorts of questions you might be starting to formulate now, such as, well, what happens if mum or dad moves care home? Is it portable? Yes, it is. What happens if care home fees go up? Well, we'll get you quotes with and without escalation. So you can compare and decide whether you want to build in some protection, index linking, for example, or whether you want a cheaper policy and you'll cover the fee increases from your own remaining, the remaining capital. All things will guide you on, but the reports will cover and give you an indication of the different options. And as I said, it's a risk if somebody dies early, but you can mitigate against that. You can't erode the risk completely because it's insurance. You're never going to get a no risk option, but you could pay a bit more and have some of the capital protected in the event of early death so that there is a refund. Or you can delay the start date of the policy. So this is still a version of the policy that you buy now, just like the immediate plan, but you defer the start date of the policy. So you tell the insurer, I'm buying it today, but I don't want you to start paying tomorrow. I want you to start paying in 2 years' time if mum's still with us. The insurance company will then drastically reduce the price of the policy because you're not asking them to pay out for 2 years. And then when we get to the beginning of year 3, if the individual is still here, they start paying for the rest of their life from that point onwards. So you've still got your longevity risk covered, but you're not paying as much for the policy. So you don't stand to lose quite as much money. So this is a really misunderstood option. I mean, if you can even find an IFA that understands these policies inside out, you're doing well, let alone if you find one that will talk to you about the positives of a deferred start date option. We'll give you the absolute best advice, which means giving you all options. And these products are all covered by the Financial Services Compensation Scheme. So it's 100% of the income that's protected if the insurer goes bust, unlike your money at the bank where 85,000 is the maximum. Okay, so just be mindful of that. Now, it might be helpful just to give you a bit of a case study. You know what it's like with case studies. They're not necessarily how it will pan out for you. So you've almost got to forget these figures after you've seen them, but it might just help, for you to understand the concept a little more. So Mrs. Evans' name has changed, not real photograph, different part of the country completely. And it was actually the daughter we were talking to. But Mrs. Evans was aged 88. She'd had a stroke and she couldn't live therefore independently in her own home any longer. Prior to this happening, she'd actually sort of built a bit of a relationship with a care home in her community. She'd gone to a couple of events, community events, so she knew where she wanted to go. But now it's come to the crunch time, she'd got concerns about whether she could actually afford it, because actually with the stroke, there's no no guideline there as to how long she might. Nobody's telling her this is a terminal illness, for example. So it was very much unknown how long she'd be paying the care fees for. What she had shared with us was via the attorney was that she had definitely wanted to leave something for the grandchildren, and she'd also got some charities she'd always supported. So she did want to make sure there was something left for those beneficiaries. So we went through a simple sort of maths exercise, if you will, taking the figures from the attorney, who shared with us that this care home Mrs. Evans wanted to go to was £1,200 a week. That is the UK average, by the way, but of course varies from county to county, as you would understand. She had some income, not huge income, but pensions and attendance allowance coming to 15,000 a year. So the gap, what we call the shortfall, the funding gap, just under £47,500 a year. Now, her asset position was that she had cash at bank over the threshold, so she's not going to get any help from the local authority, whether she has a house or not. She's getting no help. She does have a property worth 250, so her total assets are 300. So we did some sort of quick maths, if you like, just using some gentle assumptions, such as the care fees going up 5% on average, income going up by 3% on average, and any personal spending money, which was minimal, would come from the interest on her remaining savings. Could the money run out? Aged 88, yes, it could run out aged 92, roughly, 94, 6 years approximately. So that's a perfectly fair funding solution to come to, that you will just pay as you go, keep fingers crossed, and deal with it in 6 years' time, if indeed Mrs. Evans is still there. But we wanted to just put an alternative forward to the family. So we researched for them the care fees annuity to fund a gap of 47,400. We wanted to just put that in a report, comparing it to the pay as you go, and the family could then make a bit more of an informed decision. And what they ended up doing, once they'd gone through the report, gone through all the quotes and the numbers, they ended up buying a care fees annuity for £165,000 to pay that 47,400 for the rest of Mrs. Evans' life. As I say, you have to forget these figures because they'll be different for your scenario for a number of reasons. But conceptually, they were gambling, in inverted commas, just over half the estate in order to protect the other half. So the graph looks really different. You see a big dip to start with, not the steady curve, the steady line that we saw earlier. It's a big dent, then it flatlines. So we're putting the big dent in the estate to buy the policy, and then we don't have to spend anything further. So again, this assumes that the personal expenses are being met from the interest on the remaining capital. If she didn't need that, actually, you'd start to see the capital line grow again very, very slowly. So it is possible in certain scenarios to do a bit of both. It is possible to do part annuity, part pay as you go. But it's really important that if you're doing that, the bit you're funding from capital must not ever run out, because if it does, you're in a terrible position where you don't have enough money to pay the care fees. You're not going to get anything from the local authority because we've got an annuity as well as pension income. So when we do the maths, there will be more income available to Mrs. Evans than the local authority would pay for her anyway. So we've put her in a terrible position of buying an annuity, still running out of money, not getting any state support, can't pay the fees. So this is again why it's so crucial to get advice from a specialist who understands this. Not everybody does. So it's now given them options, and in this case, it was an option they wanted to take. And they took it because it ring-fenced that remaining 50% or 45% for those beneficiaries. It took away the worry of having to engage with the local authority. How much will they pay? Would they pay that care home? Will that care home want to top up? Just takes all of that worry away. And it doesn't negate any future access to NHS funding. If someone is going to qualify for NHS continuing healthcare, they still will do. It just means they don't need their annuity income anymore, so it gets paid to them instead of being paid to the care home. It does suffer a small tax charge at that point, but not at the full rate of tax, so it's fairly nominal. And as I said to you right at the beginning, we don't charge for getting to this point. So we won't charge you for that chat. We won't charge you for an estimate is it even worth researching the care annuity? We'll absolutely give you a meaningful estimate from data we've collected from our previous quotes. And if it's not going to look viable, it's not worth doing, we'll tell you that and not waste everybody's time. But if you do want us to research it, we've got a really streamlined process. So it's no bother us doing that and finding out the numbers for you and presenting you with an advice report. Arguably, it's a valuable report and it's got years and years of expertise in there. We could, and some people would say should charge for it, but we know that that's a barrier. We know from years and years and years of family feedback that until they get the report, until they understand this product, and until they can see the cost and understand the pros and cons, then they want that before they can make a decision. And if we're going to charge them for just giving them that information, they'll say, don't bother. We'll make our own assumptions and not do it. So it's a kind of a cross subsidy model. It does mean that we do charge a fee if a purchase is made, and that fee is wrapped up within the cost of the annuity, like old style commission, but we can't call it that anymore. So it is there, but only if you make the purchase. So we just feel that's best for the type of families that we talk to that want the no cost, no obligation option. There are brokers out there that might charge you for the research, charge you for the report, and then maybe charge a lower arrangement fee. But what if you don't end up buying? And it is that unknown, isn't it? So we're as transparent as we can be. If it doesn't work for you, then maybe there are other charging models out there. But be mindful, there's only 4 insurance companies that offer this type of product. You cannot go to any of them and ask for a quote. They won't deal with you direct. You have to come through SOLLA Accredited Adviser like ourselves, okay? But why us and not somebody else? Well, we do only this, as I mentioned before, and both Legal and General and National Friendly actually chose us to pilot their products when they launched to market about 4 and 5 years ago, respectively. They chose us because they know we know what we're doing. Don't just take my word for it, though. You will need to do your due diligence. I guess what I'm just saying is don't instruct 2 brokers to go to the same 4 insurance companies, because it gets very confusing and only one broker will have access to all the updates. The other one will be blocked. It's the same form that you'll fill in. The insurance companies have to give you the same quotes. So there isn't a benefit. You just do your due diligence now in choosing the broker and then just instruct the one. So absolutely make sure they're SOLLA accredited. And I've already told you we are. I help set the organisation up, in fact. Make sure that you can find the advisor on the FCA register easily. And if you Google Eldercare Solutions on the FCA register, you will find us. Probably, I think, more importantly, check out independently verified client reviews. How do you know to believe me? Well, perhaps believe the clients that have used us. And I would say if you're considering any other advisor, do the same for them. But make sure, if you're looking for care fee annuity advice, make sure that these are testimonials about care fees annuities, not about their wonderful mortgage advice or their wonderful pensions advice, because that's a whole different area of knowledge and skill. Okay, so you to some extent get what you pay for here, but please don't assume that all IFAs understand care funding, because in fact SOLLA has got members in the hundreds, not the thousands, as a UK organisation. That's how niche this is. Okay, so do your due diligence on who you want to instruct, and then let them do this unimpeded, if you like, by another broker running in parallel. So just in closing, in case it's helpful, I've landed on this very specific page of our website because it's got a care fees annuity calculator on there. Now, this is only to give you a ballpark. This is only to give you a best guess / estimate of what a care fees annuity might cost. So you click that little middle round button with the calculator on, and it will ask you the age of the person, how much income they have, what the care fees are, and that will automatically calculate the shortfall and then give you an estimate based on our experience, ballpark figure, what to expect. There's a second section underneath there where you can put in your name, email address, phone number, and any message. And if you send it, make sure you send it and that you then get a thank you appear on the screen. Because if you don't get that thank you, it means it hasn't been sent. And all of that aside, if you're expecting to hear back from us and you don't within 24, 48 hours, something's gone wrong, because we keep getting this tested and every time it's tested, it works, but something's gone awry. We always contact people within 48 hours maximum of getting that contact request. So if for some reason you don't hear from us, please just ring us. Okay, something's gone wrong. So 0800 082 1155 is our free phone number, 9 till 5 weekdays. Small team. So if I'm not available, Sarah, Tracy, Roger, Mike, any of us can help. You've got the email address there if you prefer to reach out with a written scenario. And as I say, helpful information generally here on the website. Hopefully that's covered everything we had on the agenda. So who pays for the care home? It's either the council, the NHS or yourself. We know that the means test limit is still static. We know there's no lifetime cap on care costs. We know there's a bit of help if you've got a property and nothing else. You might consider a deferred loan. But if you're a fully fledged self-funder with upwards of 3 years worth of funding, the care fee annuity may well be worth looking into. Certainly get the facts and figures on it, if only to rule it in or rule it out. And at least it does give you an alternative to pay as you go, which is the default option by all accounts. So thank you very much for your attention. I'm going to stop the webinar. As I say, I think the recording will be distributed hopefully this afternoon. And then if you need to come back to us for further advice, please do. Thanks everyone.